What if the headlines you trusted were just the tip of a financial iceberg that could have shattered the global economy? Hey, I'm Gregory Hale. I spent 10 years chasing global finance for a top weekly, sifting through balance sheets and policy briefs most folks never glance at. That's the part the headlines completely overlooked. In this video, I'll show you how one magazine's deep dive peeled back the curtain on a hidden threat, how that threat sent shockwaves through millions of jobs, and why today's credit crunch feels oddly familiar. Disclaimer: everything you hear here is my own take, built on publicly available data and my own analysis. It isn't the official line of any group, and I'm putting it together purely for educational reasons. The first hint showed up in a batch of filings the SEC posts for the public. EDGAR, the SEC's archive, stores raw credit market reports and financial statements that, once you stitch them together, spell out a pattern of over-leveraged firms and murky derivative bets. Source: SEC EDGAR. When The Economist ran a deep dive right after the 2008 chaos, its editorial crew practically winced. Its reporters tracked the contagion from mortgage-backed securities out to the broader credit system, soon seeing that the danger wasn't confined to one niche, but was systemic, woven into the very skeleton of modern finance. That finding was more than a footnote for journalists. It rang like a warning bell. The magazine's deep dive showed how tangled lending practices magnified shocks, turning a housing slump into a global credit freeze. The term systemic risk leapt from academia into everyday talk, reshaping how regulators think about oversight. The fallout hit fast and hard. Factories worldwide slowed, store shelves went bare, and consumer confidence just vanished. Employment numbers nosedived, and the BLS recorded a stark drop in the job market, with layoffs spiking and hiring contracting. Source: BLS. Households felt the squeeze. Mortgage delinquencies climbed, credit cards hit the limit, and small firms fought to get enough cash to stay afloat. That ripple showed up everywhere, from the boardrooms of global giants to the kitchen tables of everyday families. Fast forward to now, and the credit market is once again feeling the pressure. Recent Reuters coverage points to tighter credit spreads, a slowdown in fresh loan issuance, and banks pulling back from riskier lending. Source: Reuters Market News. The Fed's money and credit stats echo that vibe. Their newest data show overall credit growth shrinking, with both business and household lending showing clear hesitation. Source: Federal Reserve Economic Data. At the same time, the job market is mirroring the 2008 pattern. The newest BLS employment report flags slower job creation, flat hiring rates, and more workers reporting reduced hours. Source: BLS. Globally, the IMF's World Economic Outlook warns of a slowdown, projecting weaker growth for big economies and flagging the fragility of trade-linked supply chains. Source: IMF World Economic Outlook. The parallels are stark. A credit crunch that starts with timid banks, spreads to corporate financing, and then seeps into the labor market, turning hiring freezes into the new normal. What sets today's situation apart is how fast information spreads. Back in 2008, analysts cobbled together quarterly reports and lagging filings. Now market players react to real-time data streams, magnifying both panic and prudence. Still, the core lesson hasn't changed. When a magazine shines a light on deep systemic risk, it forces us all to re-examine the financial scaffolding we depend on. The 2008 crisis taught regulators to look past single institutions and think about the networked nature of modern credit. Now, with credit markets tightening and hiring stalling, policymakers face the same dilemma: step in early enough to stop a cascade, or let the market self-correct and risk a deeper recession. The answer will shape more than the next fiscal quarter. It will influence the very stability of the global economy for years ahead. In the sections ahead, we'll break down today's credit squeeze mechanics, compare them line by line with the 2008 fallout, and see what history hints about the road ahead. Stay with me as we untangle the risk web that started with one magazine's probe and now threatens to rewrite finance's rulebook again. So, the 2008 financial crisis, that was a really pivotal moment in modern economic history, marked by a complex interplay of factors that ultimately led to a global downturn. At its core, the crisis was fueled by the subprime mortgage crisis, which saw financial institutions extend large amounts of credit to borrowers who, let's be honest, weren't able to afford the loans. Source: Sec EDGAR. This led to a surge in defaults and foreclosures, causing a ripple effect throughout the financial system. It was like a big wave that just kept getting bigger. The proliferation of subprime mortgages was facilitated by deregulation and a lack of oversight in the financial sector, allowing institutions to take on excessive risk without adequate supervision, which is pretty crazy when you think about its source: Federal Reserve economic data. As the crisis unfolded, it became clear that the global economy was highly interconnected. Events in one region were having far-reaching consequences for others, which was pretty scary. The International Monetary Fund noted that the crisis highlighted the need for enhanced global cooperation and regulation to mitigate the risks associated with international trade and finance, which makes sense. Source: International Monetary Fund World Economic Outlook. The effects of the crisis were widespread, with significant impacts on employment and economic output. It was a really tough time for a lot of people. According to the Bureau of Labor Statistics, the crisis led to a substantial increase in unemployment, as businesses struggled to stay afloat in a rapidly deteriorating economic environment, which is just heartbreaking. Source: Bureau of Labor Statistics. Reuters Market News reported that the crisis led to a sharp decline in stock prices and a freeze in credit markets, making it difficult for companies to access the capital they needed to operate. It was like the whole system just came to a standstill. Source: Reuters Market News. The subprime mortgage crisis was a key factor in the 2008 financial crisis, as it led to a significant increase in defaults and foreclosures, causing a crisis of confidence in the financial system. It was like a big mess. The lack of regulation and oversight allowed financial institutions to take on excessive risk, which ultimately contributed to the crisis. And that's just not okay. The global nature of the crisis highlighted the need for international cooperation and regulation to prevent similar crises in the future. We don't want to go through that again. The crisis also led to a significant increase in government debt, as governments around the world implemented fiscal stimulus packages to try to stabilize their economies, which is a pretty big deal. In the years leading up to the crisis, there was a significant increase in the amount of credit available to borrowers, which contributed to a housing market bubble, and we all know what happens when bubbles burst. When the bubble burst, it led to a sharp decline in housing prices, causing a wave of defaults and foreclosures, and that was just devastating. The crisis led to a significant restructuring of the financial sector, with many institutions forced to merge or seek government support to stay afloat. It was like a big shake-up. The crisis also led to a significant increase in regulatory oversight, with many governments implementing new rules and regulations to try to prevent similar crises in the future, which is a good thing. The 2008 financial crisis was a complex and multifaceted event, with a wide range of causes and consequences. It's still hard to wrap your head around it. It highlighted the need for careful regulation and oversight of the financial sector, as well as the importance of international cooperation and coordination, which is just common sense. In the aftermath of the crisis, many experts called for a fundamental reform of the financial system to prevent similar crises from occurring in the future. We need to learn from our mistakes. This included calls for greater transparency and accountability, as well as stronger regulations to prevent excessive risk-taking, which is just basic stuff. The crisis also led to a significant shift in the global economic landscape, with many emerging markets experiencing rapid growth and development. That's a positive thing, right? However, it also highlighted the need for careful management of economic risks to prevent similar crises from occurring in the future, which is a big responsibility. Overall, the 2008 financial crisis was a significant event that highlighted the importance of careful regulation and oversight of the financial sector. We can't afford to forget that. It led to a wide range of consequences, from significant job losses to a major restructuring of the financial sector, and that's just a lot to take in. The crisis also led to a significant increase in government intervention in the economy, with many governments implementing fiscal stimulus packages and monetary policy measures to try to stabilize their economies. It was a big deal. In the years since the crisis, there have been many efforts to reform the financial system and prevent similar crises from occurring in the future. We're trying to get it right this time. This has included the implementation of new regulations and rules, such as the Dodd-Frank Act in the United States, which is a step in the right direction. The crisis also highlighted the importance of international cooperation and coordination, with many experts calling for greater collaboration and information sharing between governments and regulatory agencies. We need to work together. In conclusion, the 2008 financial crisis was a complex and multifaceted event, with a wide range of causes and consequences. It's still a lot to process. It highlighted the need for careful regulation and oversight of the financial sector, as well as the importance of international cooperation and coordination, which is just the way it is. Today's credit market is sounding the same alarm bells that first rattled Wall Street back in 2008. Lenders are stepping back, corporate bond spreads are climbing, and the pool of available financing is shrinking faster than any recent cycle. Federal Reserve credit data now point to a steep drop in bank-originated loans, a pattern that mirrors the credit freeze that came before the Great Recession. Source: Federal Reserve Economic Data. Meanwhile, SEC filings are showing a surge in covenant-heavy debt structures, a trick companies use to lock in financing before markets hardened. Source: SEC EDGAR. Those parallels aren't just skin deep. In each era, the first ripple was investors losing confidence, which then turned into tighter underwriting standards. Reuters market commentary points out that risk premiums on high-yield issuances have climbed to levels we haven't seen since the early 2000s. Source: Reuters Market News. The upshot is a credit crunch that forces firms to put expansion on hold/capital spending, and in many cases, renegotiate existing debt. When credit dries up, the labor market feels the pinch almost right away. The BLS's monthly employment reports show a hiring slowdown that lines up with the tightening of credit lines. Companies that used to add staff each quarter are now hitting hiring freezes, and some have even announced layoffs to preserve cash. That swing from robust hiring to a freeze is a textbook sign of a credit-driven slowdown, just like we saw in the years before the 2008 collapse. This slowdown is also reshaping the broader economy. The IMF's World Economic Outlook flags a slowdown in global growth, pointing to waning consumer confidence and a pullback in business investment as key drivers. With fewer loans reaching manufacturers and service providers, demand for goods and services contracts, feeding back into weaker GDP numbers. In the United States, the same trend shows up in the decline of credit-related activity reported by the Federal Reserve, a sign that the engine of economic expansion is sputtering. A key difference, however, lies in how policymakers respond. After 2008, central banks and regulators rolled out a suite of liquidity facilities and stress testing regimes that helped shore up the banking system. Today, policymakers face a choice: act decisively to inject liquidity and restore confidence, or risk a prolonged stretch of credit scarcity. The Reuters feed warns that markets are already pricing in higher risk premia, a sign investors are demanding compensation for perceived policy inertia. Source: Reuters Market News. If action remains half-hearted, the fallout could cascade far beyond the financial sector. Credit-starved firms may default on existing obligations, sparking a wave of corporate bankruptcies that would amplify job losses. BLS data suggests that each contraction in credit activity historically precedes a rise in unemployment claims, as businesses cut payroll to stay afloat. A prolonged credit crunch could therefore stall the IMF's projected recovery for the next few years, pushing the global economy back onto a low-growth plateau. On the flip side, a proactive response could blunt the shock. Targeted lending programs, similar to those rolled out after the last crisis, would help bridge the financing gap for small and medium-sized enterprises companies that employ a disproportionate share of the workforce. By stabilizing cash flows, such measures would keep hiring on track and preserve consumer spending, which in turn fuels demand for credit. Federal Reserve data show that when credit conditions improve, loan growth rebounds quickly, offering a clear path out of the downturn. Source: Federal Reserve Economic Data. The stakes are amplified by the interconnectedness of today's supply chains. A credit shortage in one region can ripple across multiple economies, as suppliers struggle to finance inventories and logistics. The IMF highlights that emerging markets, which rely heavily on external financing, are especially vulnerable to a global tightening of credit. Failing to address the current meltdown could therefore trigger a synchronized slowdown, eroding the modest employment gains of the past few years. In sum, today's credit market mirrors the early stages of the 2008 crisis: widening spreads, reduced loan issuance, and a cautious investor base. The immediate fallout is a hiring slowdown that threatens to turn a credit crunch into a broader economic contraction. The policy window is narrow. Decisive, well-targeted interventions can restore liquidity, protect jobs, and keep the global economy on its projected growth path. Inaction or an inadequate response risks a feedback loop of defaults, layoffs, and stagnant growth, a scenario that both regulators and market participants have worked hard to avoid. The narrative is clear. Credit is the lifeblood of modern commerce, and when it thins, the whole system feels the strain. By learning from the past and acting now, leaders can prevent a repeat of the systemic risk that once forced the world to recoil. So let's take a closer look at the 2008 financial crisis. It's pretty obvious that the lessons we learned back then are still super relevant today. I mean, the crisis really drove home the importance of being vigilant and taking proactive measures to mitigate systemic risk, as we can see from the credit market reports and financial statements available on the SEC EDGAR database. Source: And the aftermath of the crisis had a huge impact on employment. The Bureau of Labor Statistics reported a substantial increase in unemployment rates, which is pretty eye-opening. Source: Now, the Federal Reserve's money and credit statistics also highlight the need for careful monitoring of economic indicators to prevent similar crises from happening again. Source: And if we take a look at the International Monetary Fund's World Economic Outlook, we can get some really valuable insights into global economic trends and projections. It's all about cooperation and coordinated policy responses. Source: Reuters Market News is a great resource for up-to-date analysis of market trends, and it's a good reminder that staying informed is crucial when it comes to navigating the complexities of the global economy source. It's really important that policymakers, financial institutions, and individuals take a proactive approach to managing risk and promoting stability. We can't just sit back and wait for something to happen. By learning from the past and staying vigilant, we can work towards preventing similar crises from occurring in the future. So, what's the takeaway from all this? We need to prioritize transparency, accountability, and cooperation to ensure the long-term health of the global economy. It's pretty straightforward, right? This requires a collective effort to address the underlying issues that contributed to the 2008 crisis, including inadequate regulation and reckless risk-taking. By working together and embracing a culture of responsibility, we can build a more resilient and sustainable economic system. It's not going to be easy, but it's definitely doable. The time for action is now, and it's up to us to seize this opportunity and create a better future for all.